안녕하세요. 한국경제신문 뉴욕 특파원 박신영입니다. 저는 지금 맨해튼에 있는 누빈자산운용의 오피스에 와 있습니다. 오늘 제 옆에 계신 분은 누빈자산운용 채권 부문을 담당하고 계시는 앤더슨 펄슨 CIO님이십니다. 누빈은 한국으로 치면 교사, 보험 및 연금 연합회의 자회사로 있습니다. 누빈이 운용하는 전체 AUM은 약 1.2조 달러고 특히 채권 부분은 4,230억 달러에 이릅니다. 큰 돈을 운용을 하시는 분이고 특히 누빈은 채권 부분에서 강점을 띠고 있어서 한국에서도 많은 투자자들이 주목하고 있는 회사입니다. 오늘은 이런 채권 투자와 관련해서 전반적인 미국 경제와 관련해서 또 질문을 드리려고 합니다. Thank you for having us.
Thank you.
Yesterday, the treasury yields surged. That is because of growing caution around the interest rate cut. So is this good time or a bad time to enter the bond market? How do you think about that?
I would say overall we're finding that fixed income in the bond market is attractive and a good time generally to be entering the markets right now. We kind of felt like the market got a little ahead of itself earlier in the year where, a number of Fed cuts and central bank cuts more broadly were getting priced into both the US markets and globally as well. I think the reset that we've seen here over the last several weeks is quite healthy, as we felt like, again, the markets were just anticipating too many cuts and too quickly. So we're finding that overall it's more of a balanced setup right now, and the yield environment at a little bit over 4% from a treasury perspective is quite attractive. Now we're not expecting a dramatic rally necessarily in the yields. We actually think that we're going to be a bit more range bound here, and the market's going to be just like the Fed, a bit more data dependent. So we would expect yields to be a little bit more range bound, but all in all, if you look in versus historical levels, yields are attractive, and the income generation opportunity that we're seeing in fixed income is very attractive in our mind, and particularly as you compare it to other asset classes as well.
The election day is coming. The possibility of a tariff increase is pushing pressure on the bond yield and bond market. So what are your thoughts on this? Can it be a big burden on bond market? How about that?
Yeah, I would say we certainly are mindful of the election outcome overall. I will say, before addressing kind of the tariff question, I think currently we're not making any major changes to our portfolios and our allocations in general. The reason why is really because it is a true toss-up, so to say. It's unclear which side will be winning, and what we're particularly focused on is if it's going to be a sweep on one side or another. So Republican kind of sweep winning the presidential side as well as the House and the Senate, or the Democratic side. That to us is the more important kind of type potential outcome. Our base case right now is more of a gridlock, which would be in our mind probably the best for the markets more broadly. It does kind of have some checks and balances, so you don't have a party kind of pushing through too many policies, so to say. I would say the tariff part is definitely a key one that we're focused on. What's a bit unique with tariffs is that the president actually has a fair amount of power to implement those tariffs, even if the Congress is split. So that gives power to the president to perhaps, as you're saying, pushing that through and having an impact on the economy overall. So, what we've learned from, the Trump presidency in the past, that there is certainly a fair amount of discussions ahead of the elections and maybe not a push through all the time. So that's something that we're trying to be mindful around. In other words, if, basically Republican and the Trump were to win the White House, yes, that does raise a little bit more concern around the tariffs that he's discussing, but it doesn't necessarily mean that those will be implemented, at least not to the levels that we're hearing right now. So I would say, yes, the market is mindful around it, but given, again, it's unclear who the winner will be, if it's going to be, Trump or Harris at this point. In addition to that, given it's quite unclear what can be implemented, and again, if there's going to be more of a split government. At this point, I think the market is mindful around it, but we have to effectively wait for the election outcomes to see what that looks like and how possible that risk should be going forward.
There is projection that 10-year treasury yields could reach 5%. Do you agree with that?
In a short answer, most likely no. We think that's unlikely. I will go back to my point around if there is a sweep one way or another, particularly a Republican sweep, because both sides have spoken about some pretty ambitious fiscal spending programs, and if they do get implemented, again, a lot of speculation and talk ahead of time, and getting things implemented may be a little bit different. But hypothetically, particularly for the Republican side, given that they have the tariff discussions, as we just talked about, some of the tax cut that they're discussing, some of the fiscal spending in general, that could put a fair amount of pressure on treasury issuance and just in general borrowing, which already is quite, stretched, so to say. So, I think the 5% kind of yield target, let's call it, could perhaps come in play if you were to see that Republican sweep and if you see them following through on, the various policies that they're discussing. If, again, our base case is probably more of a split government, a very tight kind of type election outcome, then our base case would not be that we see, rates going that high. Our current base case is, sort of a 4% kind of trading range for a bit longer on the 10-year. We think that's more or less fair value right now, and we would expect that to be sort of our base case as we go into beginning of next year as well. So the other piece, of course, let's not forget that the economy is going to be driving a lot of what, rates and the Fed, kind of movements going forward as well. So we want to make sure we don't forget that the economy will be the main driver going forward, and we will, we and the Fed will be quite data dependent in assessing where our yields will be going. But again, our base case right now is sort of like a 4% range, more or less, and then seeing that actually continue for the next few quarters.
These days, the stock market is so bullish. Does that make bond market less attractive?
No, I would say on the contrary, I would probably argue that the bond market is becoming more attractive. The stock market, to your point, has rallied a lot here in the US, and multiples both on a trailing and a forward-looking are kind of a historic high, so to say. So, from that perspective, we're kind of looking at that saying, listen, from a risk-reward perspective, we actually feel like the fixed income markets, and particularly the credit markets, is really attractive versus equities right now. Given the corporate fundamentals are holding up quite well, our base case is for a sort of a soft landing here in the US going into next year. We're comfortable getting credit exposure and basically reaching for a little bit of a yield. If we have that soft landing, we would expect the income part of the fixed income opportunity set to be very attractive and kind of clip the coupon, as we say. On the other hand, if we are wrong and maybe we have more of a harder landing, the economy starts really slowing down and perhaps we get a recession, then while credit spreads will widen, most likely, for sure, I would say, you will see the rate side rally, because most likely that means the Fed will have to cut rates, Treasury will go, yields will go lower, and then your total return gets pretty okay in that outcome as well. Whereas the equity markets, if we have more of a harder landing or any kind of Fed policy error, most likely would sell off fairly dramatically. So from a risk-reward perspective, we're finding fixed income to be attractive. The other piece I will mention is that today, when the yield environment is a fair bit higher than it was a few years ago, and as we're seeing inflation going lower, we are expecting fixed income to have that negative correlation to stocks more so going forward than we've seen in the past several years. The concern with fixed income for some time was it was positively correlated with equities for a while there. So you really didn't have the diversification benefits as much as you may have had, going back in history. Our assessment is now, when inflation is coming lower, we've done some study showing that inflation goes to 2.5 and below, which is where we're heading. That's when the correlation benefit starts kind of kicking back in. So diversifying your portfolio with fixed income is becoming a lot more attractive versus having just stocks as a whole. So all in all, I would say valuation's a little bit more interesting. The risk reward is more balanced, and then the correlation aspects is now playing into the favor of fixed income again.
I'm planning to ask about the possibility of no landing or soft landing, and how are you changing your strategy? But you already answered.
Yeah, I mean, maybe I'll elaborate just a little bit further. Again, I would say our increasingly our base case is for sort of a soft landing. A couple of reasons why we're becoming more confident around that. I would say number one, the Fed, doing their first 50 basis point cut gave us a lot of confidence that the Fed is going to be fairly proactive. They're going to be actively, addressing, the slowdown in the economy. We were getting a little concerned that they were perhaps a bit too stubborn and only focused on the inflation side of their mandate. We're now recognizing that they're mindful of both sides of the mandate and keeping an eye from the economy, and this potential slowdown. The other part that we got some comfort was that the jobs numbers, the labor market rebounded a little bit. It was, unemployment rate was moving up quite quickly. Now we're seeing that slowing down a bit, which makes us much more comfortable that we're going to have this soft landing. Possibly no landing even. It's a bit difficult to determine exactly what those terms mean and what the difference is. Now, I will, of course, caution that ourselves and the Fed, again, will be data dependent, and there are a lot of crosswinds in the broader U.S. economy and global economy. So we will reassess that view. But as we're sitting here today, our base case is for a soft landing. And how are we approaching the portfolio decisions around that? Tying into, as I said, we're a little bit more comfortable going down into below investment grade and credit in general. We, feel a little bit more comfortable going slightly longer duration, although we're more or less neutral at this point. But before we've been short duration to lock in some of the fixed income yields that we're finding at this point. But we're still stressing diversification. We're stressing active management and, leveraging our very large team of investment professionals here at Nuveen to really finding those opportunities that are still very much out there in the fixed income space.
Some member of FOMC reportedly think that's going to be maintain this interest rate on the coming November FOMC. So does it affect your strategy?
Yeah, I would say our base case is for a 25 basis point cut at the next meeting. Given what we've been seeing with economy, the jobs market, what have you, the market is still expecting a 25 basis points cut, but the probability has moved down a little bit lower. I would say we're trying to look through that a little bit and kind of thinking a little bit medium to longer term, where as long as the trajectory is sort of what we're expecting, which is basically that the Fed will continue to cut rates throughout next year, we aren't necessarily changing our portfolios in a drastic way based on would it be 25 or maybe 50 or zero? We certainly want to be mindful of that. We're, as I mentioned, kind of more neutral duration, which will be the piece that will probably be most volatile around a shift in that kind of type policy. And instead, we're finding, really attractive opportunities in the credit space and the securitized space. And again, leveraging our large team to kind of finding more bottom-up opportunities. So I would say it probably is not going to dramatically change our approach to investing, but we obviously want to be mindful around if there's something there that's shifting the expectations materially, or if the Fed is potentially seeing something that we're not seeing, which wouldn't be our expectation. And I have to say, it's a little bit what the Fed has set up us to expect, right? It's going to be very data dependent. And if the data is moving around, we will have some volatility around that. So we're keeping a little bit of dry powder to make sure if there is a bit of a sell-off that we can step in and take advantage of that.
I'd like to ask a more specific question. Which sector do you currently find the most attractive in these days?
Yeah, I would, as I stressed, I think we're finding a lot of interesting opportunities across all of fixed income, and we're really stressing to investors to diversify across the whole universe. And we at times tend to think about treasury rates only and forget that we have a full spectrum of opportunities in the fixed income space, from the muni space into taxable fixed income to even private fixed income. So we're really looking to take advantage of all of the opportunity sets that we have in front of us, so to say. That being said, within the public taxable space, as I mentioned, we're quite comfortable with credit still. We've been focusing on some of the higher quality, high yield and leveraged loan opportunities. Given, again, we think corporate fundamentals are holding up quite well. The yield profile is still very attractive there. We are finding some opportunities in preferreds, which is a very aligned to the financials and banking kind of issuers, which we've seen very strong earnings from them just here recently in the third quarter, expecting that to be quite attractive going forward. Securitized is a big, broad space, and we've been able to find quite a lot of opportunities in that area, some on the ABS side, some on the CMBS side. And finally, I will definitely say that in the muni area, the municipal areas, which is a big focus of ours as a firm, we're really finding attractive opportunities there. Overall, fundamentals continue to hold up incredibly well. We've seen a lot of supply, a lot of muni issuers been coming to market ahead of the elections. So we think now as we get closer to elections, that supply demand should even out a fair bit, and we could see some spread tightening and some opportunities in the muni space going forward. So it's a long answer in saying that we're finding quite a lot of opportunities across the broader universe and taking advantages of those in our portfolios.
The issuance of a low-rated corporate bond is increasing. Is that kind of investment is rational or reasonable? How do you think of it?
We certainly have seen a lot of issuance of both high-yield bonds and leveraged loans, and of course private credit has been very, very popular over the past year or two, so to say. It's not all that concerning to us. We're finding that corporate fundamentals are holding up quite well. We're finding that management teams are being very proactive in making sure they're locking in some of the more attractive yields that we've been seeing. As we discussed a bit, the spread levels are quite tight all in all. So, management teams are taking advantage of that, and there's a lot of demand for, below investment grade opportunities. So therefore, the market is happy to kind of take that supply on, so to say. We're also finding that management teams are very mindful about a potential harder landing or a slowdown in the economy and pushing out the debt maturities to make sure that they don't run into any kind of liquidity kind of squeeze, so to say. So all in all, we're selectively participating in the new issuance and trying to find our spot, so to say. But at this point, it's not like we're finding, say back in 2007, there was a lot of aggressive, triple C kind of offerings, very highly levered LBOs, what have you. We're not finding that to be the case at all. It's more single B, double B kind of rated credits that we think make sense in this kind of type environment. So, I would say we're finding opportunities and not finding that to be a concerning kind of red flag for credit markets at this point.
What are your expectations for United States Treasury yield end of this year?
Yeah, so we would expect Treasury yields to be fairly range bound here for the rest of the year. So we felt like the market got a little bit ahead of itself earlier this year, particularly in the summer, pricing in too many Fed cuts and being a little bit too proactive probably around that. And at this point, we've seen a pretty dramatic repricing of that where yields have moved up a fair bit, which we're finding now to be a lot closer to fair value, a lot more interesting. And again, the income portion of fixed income now is a lot more attractive. So I would say by now and year end, we're expecting that the 10-year to be in that low 4 kind of type area, so more or less range bound, and the 2-year to be a little bit lower than that. And we already seen, a steepening of that curve, which we would expect to continue, particularly as we move into 2025. In other words, we think more of the action, so to say, will be on that front end as the Fed continues to cut rates, whereas we think the 10-year will be more anchored around that 4% yield, partly related to some of the issuance needs that probably will come as we move into next year, depending again on the election outcome and if there's a fair amount of fiscal stimulus or fiscal spending coming. So that probably will mean that the 10-year is going to be anchored around that 4% for some time.
Do you see opportunities in bond market out of the US?
Yeah, absolutely. I mean, we're definitely looking across the full global investable universe from a bond perspective. I would say overall, as a whole, we probably are favoring the US market a bit over the global or non-US market. But nonetheless, particularly on the rate side, the sovereign side, we're finding that there are opportunities, particularly in Europe at this point. The reason why is that we're seeing the central banks in Europe, particularly the ECB, to be more aggressively cutting rates. They need to kind of stimulate the European economy more aggressively than the Fed needs to stimulate the US economy. So we would expect a bit more aggressive cutting of rates there, and therefore yields to move lower, and therefore that part of the market offering more more attractive total return opportunities. So we're more comfortable going a bit longer duration in Europe than we are in the US. We're a little bit less excited about the below investment grade, kind of higher yield, higher income opportunities in Europe, really tied into the fact that the economy is slowing and has been a little bit more exposed to what China outcomes will be, some of the geopolitical kind of uncertainty. The auto industry is having some headwinds. So we're a little bit more comfortable taking particularly the below investment grade credit exposure here in the US. Asia is offering some opportunities as well as emerging markets overall. So, we're looking for a little bit more stability in the interest rate environment and also the dollar. We probably need that to kind of settle down and become a little bit arguably weaker for some of those asset classes or regions to kind of perform better. But all in all, looking for diversification across the globe at this point.
지금처럼 채권 금리가 올라가는 시기에 채권 투자에 대한 관심이 굉장히 커지고 있는데 거기에 대한 답을 앤더슨 펄슨 CIO님께서 해주셨습니다. 독자 여러분께 많은 도움이 됐으면 좋겠습니다. 지금까지 한국경제신문 박신영이었습니다.